Mr. Dinanath Dubhashi, Managing Director and CEO at L&T Finance Holdings, join us on the show to make sense of the Q4 performance as well as talk to us about the numbers going forward. Good morning, sir. Thank you so much for joining us. First up, congratulations on a strong set of numbers, but give us your assessment on the quarter gone by and how has the year been for you?
Sure, that's right. First of all, thank you for your congratulations. As you have seen, the quarterly PAT is up by 28%. It is important to understand how it has come. So I've been speaking, we have gone through the COVID years, emerged stronger on the other side of COVID. But the important thing is now where the growth is going to come from. So we are guided last time the way the retail is growing and the growth is going to come from retail. So the important numbers actually is that we have done this year our best ever retail disbursements of close to 25,000 crores. This quarter is our best ever quarter of retail disbursements. It is the best ever quarters of micro loan disbursement. So there are many best ever that has happened, and that is where the growth is going to come from. So the entire swivel of the balance sheet from wholesale to retail is happening. Retail is now 51%. Good things is that the new products which we have launched, like these are digital native product, completely paperless, have also grown. This quarter we did almost 800 crores disbursement of our consumer loans, which is completely paperless. And this trend we expect to continue, and I will talk a little bit more about it. But the good things which are happening because of this retail shift is one, the NIMs plus fees are going up, and you will see continuously quite a few quarters now. It is remaining in the 8% area. In fact, in Q4, it is 8.17%. Credit costs is becoming more and more predictable because of that. So we at this point of time, GNPA is down, as you know, smartly. But at the same time, we are actually, in addition to our provisions, we are also carrying 1,700 crores of additional provisions. We had thought that perhaps we will start releasing something this quarter, but we are not released. The board felt that, with the talks of a fourth wave, etc., we should be a little more careful. So the good thing is the entire 1,700 crores we are carrying into the next year. So all this bodes extremely well for the years to come. And with the various measures that we have to grow retail, and on Monday we are actually unveiling a strategy for future growth and what we are, how we are going to grow over the next 4 to 5 years, what we call the Lakshya 26 strategy. But very clearly, retail, various ways to grow retail business, it bodes extremely well for the company.
Mr. Dubhashi, point taken, and you sound fairly optimistic about the retail segment as well. But going forward, if you can help us with some numbers, you already talked about how the net interest margin plus fees is in the 8% range. Will it continue in that level? How do you see the net interest income moving going forward?
As far as net interest income is concerned, okay, we have now reached, in excess of 8% NIMs plus fees. It is coming out of two things. One, increasing retail. Two, best ever cost of funds. Okay. Now, as you all know, we are talking about slowly hardening interest rates. Now, this is where two things will come to our help. One, in retail, we have much better pricing ability than wholesale. So, to quite some extent, we will be able to pass on any increase to our customers because of the strong competitive position that we have in many of our retail products. Secondly, our retail normally, as the percentage increases, the overall tenor, the overall maturity tenor of the balance sheet comes down because retail are shorter tenor assets. And because of that, our liability tenor can also, duration can also come down. And hence the increase in cost, interest cost will not be proportionately higher because the maturity of the balance sheet will also come down. So both these things will, as we go, benefit us. And as interest rates harden, we believe that if at all any reduction is NIM is there, it will not be anything substantial. So we should be able to manage this NIMs plus fees at very healthy level of 8% plus or minus a few basis points. So that's clearly what we are confident.
Okay, fair enough, point taken. But as rates harden, cost of funds will get more expensive for you. Also, you have a capital adequacy ratio which is healthy at this point of time. Do you think it is sufficient to help your growth going forward as well?
Okay. The capital adequacy currently is 25%. And actually now the push is more for growth because capital is more than adequate. And even at a very healthy CAGR of 20% plus in retail, because in wholesale we are going to follow. So I will also tell you a couple of more things which we have said before. In real estate funding, we have stopped further underwriting, and we are looking at various ways of reducing the real estate portfolio. In fact, it is being quite reduced quite smartly through collections, and we will look at various ways. In infra, we are continuing a capital light model of growing. So infra book definitely is not growing. We will look at ways of maybe in that very strong platform, perhaps exploring ways to get some partners and things like that. Because of that, the capital is more than adequate, even for a 20% plus CAGR of retail. So at least the way we are planning, it looks like in the next 3 to 4 years, we won't need to raise equity capital. It doesn't look like that. Even at this very healthy CAGR of retail, we will have quite adequate capital.
Can you just talk about asset quality as well? As I can see, your gross 3-stage assets have come down sharply QOQ. Talk to us about the improvement. Do you see credit cost going lower from here on?
So the improvement is because of two things. One, on retail, all our collection ratios are actually back to pre-COVID levels. And in fact, in some cases, even better than pre-COVID levels. GS3 comes much later. We monitor very strongly our zero DPD. And that is where our data analytics and digital drives are tremendously helping us. So product after product, our collection efficiencies definitely better than last year. In many products actually are reaching better than pre-COVID levels. So that is number one reason that the retail portfolio is really smelling of roses. Wholesale portfolio, in our, it is under good control. Also, in accordance in our strategy of reducing capital to wholesale, we actually even sold some wholesale assets to ARCs in this quarter. So these two are the main reasons why the GNPA has come down. So one is a one-time big reduction because of this ARC sale. The second is a sustainable reduction with retail asset quality continuously improving. Credit cost, I don't want to give a very specific guidance, but most definitely you take it like this, that last 2 years, we have been creating substantial amount of management overlays in addition to the NPA provisions. And next year, hopefully, we may not create additional. In fact, we will be perhaps writing back some of those provisions. So credit cost should certainly trend down as we go now year after year. I will be cautious for one more quarter to watch how COVID fourth wave goes. But third wave, which came in January, hardly affected business or collections. So we hope that the intensity of COVID is not that strong and it doesn't lead to any lockdowns or anything. We should be fine.
Thank you so much, sir, for taking out time for us.